you even know what your EBITDA is?
My what?
Earnings before interest, taxes, depreciation, and amortization.
What is EBIT and what is EBITDA? Do you know what it is or not? And do you know the differences between them, which could be very crucial when you are valuing your company?
And selling your company, getting money, cash.
Yes. And today, Kat, our business lawyer,
Hello.
she's going to explain how to calculate these two words and how you can use them.
Yeah, and in particular, we're going to give you negotiation tips. What can you do to make sure you get the maximum value of your company, or if you're buying a company, how can you make sure you're not overpaying? So we're going to give you those tools in the end of the episode, because that's really what we can contribute with.
Yes.
And we can also recommend some other, more if you just want to know like the nitty-gritty financials, we're going to link to Finance Kit below and to mergers and inquisitions, because those do like many videos with detailed calculation. Here, the business law, the negotiation tools you need, and the understanding you need in order to ensure that you get the proper payment for your company. So we're going to start with the basics.
Yep.
So we have a company here.
Yep.
Optimistic LLC. They have an income statement, as we all do, right? So here's the net income. But the net income is a bad metric, actually, if we want to know what the company is worth to a potential buyer. And why is it a bad metric?
I don't know.
Too many variables. So too many variables, and we're going to come back to that. So typically, we like to use something called EBIT, and that is earnings before taxes and interest, or actually interest and taxes. So in order to calculate the EBIT, we want to take the net income,
Yes.
$2.4 million US dollars, plus we want to add back the taxes, that expense, and the interest, that expense. So why do we want to do that? We want to add back from the income statement these two expenses. Well, the reason is that a potential buyer does not care how you finance the business. Is it with your equity or with a loan? Doesn't matter.
It doesn't matter.
So we want to remove that when we want to know the earning capability of the core business of this company. And taxes is also a poor measurement, because we don't care what jurisdiction you're in when we want to know and compare your company with other comparable companies within the same sector, growth, etc. So we want to remove that expense as well. And how do we remove them? Well, we have the end result, so we add them back. They're add backs. Well, what about, and we're going to come back to this, so stay tuned, because that's not it for the EBIT either. But before we go on to normalization of the EBIT, we're going to talk about EBITDA. And that is when we do not want to know either depreciation or amortization, because that's the CapEx expenditure. And we don't think that those are either relevant for this type of business. So then we take the net income and we add back the interest, we add back the taxes, we add back the depreciation and the amortization, because that's CapEx. That's right, when you have long term, you have costs for fixed assets, you buy a car, real estate, tools and equipment that will last you more than a year, so you depreciate them. You portion out that cost during the whole period you will have that. Let's say that you buy a car and you assume that you will have it for 5 years. You will divide that and then you will have a cost of 1 million for 5 years instead. But me as a buyer, I might say that in our case, the CapEx will skew the result. Those are not relevant for this type of business. So I want to remove them when I have the relevant earning capabilities of this company. Then I will look at the EBITDA. But if we're talking about a CapEx-heavy industry, we say that the CapEx is actually part of the core business. Then I would not want to remove them. Then I would want to look at the EBIT. because then they are relevant for me. So they're relevant in the comparison. If they're not relevant in the comparison, I want the EBITDA. I want to add them back because I don't really care about them. So, and also if you're an early on company, you might say that typically we have a low capex in the type of business industry I'm in, but the first years we've been heavy on the capex. So I want you as a buyer to look at the EBITDA because that's more relevant for you. That can be an argument. Because you want, of course, the highest metrics possible with the highest multiple, and we'll get back to that. And the multiple, I can say that right away, that is that typically when you're going to talk about what you're going to get for the company, you will take a metric, you will take EBIT, and you will take a multiple. You look at what comparable companies have sold on the market, and you'll say perhaps it's EBIT times 3, and that's the value of your company. Or it's EBITDA times 6. So that's a multiple, that's relevant. So you want the metrics and you want a multiple. But before we get to the multiple, we want to know, is this actually the correct calculation to get to your EBIT? And is this actually the correct calculation to get to your EBITDA? We need to normalize it. And this is very important for you if you own a small or mid-sized business or you're looking to buy one. Because there are a lot of money to be made by doing a proper normalization process and not getting fooled by a savvy buyer coming in and saying, well, this is normalization, bum, bum, bum. So what's that? Well, what we're interested in is the earning capability of the core operations, right? That's what we want to know when we look at the EBIT, and we want to know that's representative of the value of the company. So what if this contains or lacks information? It might be expenses that are not part of the normal operations, that are non-recurring and that are one-off that happened this particular year. For instance, you might have been in a lawsuit, so you have legal fees of 100,000 and you have to pay damages for 200,000. So it might be an expense here hidden for 300,000 that's completely irrelevant for the earning capabilities of your companies. Then you would want to do an add back. So then you want to add that expense back. So you say plus 300,000. Or what if because you want the highest, if you're selling the company, you want the highest EBIT possible. Me as a buyer, I would want to normalize and push it down because then I pay less, right?
Yep.
So what if, let's say that you as the owner, you haven't been taking in any salary. Often happens, right?
Yes, very common.
Yeah. Then I would say, well, that skews the result because if I buy the company, I will have to employ a CEO, and a fair market salary for a CEO in this industry would be $1 million yearly. Okay?
Okay.
So then it's an expense that does not show. So then you want to take that back. You want to do a minus. You want to lower the EBIT with $1 million, right?
Yeah.
So you want to lower it. That's a take back. You have too little expenses in this normalization process. But what if you, because you're the owner, full owner, and you take 2 million in a CEO salary?
Yep.
That's better for you. Yeah. And I mean, you love travel.
Yeah.
So you have to go to all of the conferences. So we have a travel expense of 50,000 yearly. It's so important for you, right?
Yes, it is.
Well, then you can argue, when you're selling the company, that in the normalization process, when I employ a new CEO as a buyer, the fair market value will be 1 million. And those travel expenses, those were actually perks. They're not part of the earning capabilities, the core operations. You do not need them as OPEX, right? So then we can take those expenses out, which means that we add the expenses back. So then if you say fair salary is 1 million, you have taken 2 million. Too high expense, right? So then we add back 1 million and we add back the travel expense of 50,000 because again, not part of the core operation. So in the normalization process, you can get a higher EBIT if you can argue that expenses that you have had the past year are not part of the core operations or they are not reoccurring. And the same with income. If you have an income that's not part of the normal operations and that will be non-reoccurring. Let's say you got a COVID contribution, right? That does not help me as a buyer going forward. That's irrelevant. So then you want to take that back. So you want to lower the EBIT with that in the normalization process because that will not be reoccurring. It could be. And then we can say that it's reliable and should remain. So that's the argumentation between the buyer and the seller in the normalization process.
Okay, and that means you need to be transparent with all the costs.
Yeah, and do your homework so you know. So if you want to sell at the highest value possible, you will, of course, number one, you will want to know which is the best metric for you.
And how do you know that?
Well, number one, there's no best metric. You can use both. You can use the other ones. You can look at discounted cash flow, but that can be hard if you're a small business because you typically is rather volatile. So more or less common that you use that. But if we use EBIT, that might be the best for you, and you can argue why amortization and depreciation is not relevant for you. Or you prefer, because you say that, well, we've been CapEx heavy right now, but it's not representative. It will skew the results. So we want to go with EBITDA and disregard these costs as well. So remember, argue with whichever gives you the best starting point. Then we come to number 2 will be the multiples. Here you want to do your homework. So you want to check your industry, your growth section of that industry, your jurisdiction. What is the typical multiple? And here you can compare them a bit with each other. So do that before you go to the seller, to the buyer, I mean. So perhaps you can find, the buyer might say, well, we want a 3x multiple here. That's the comparable. So we have this company, and that company. Well, if you do your homework, you might say, well, those are more mature. We're early growth company. And if you look at our revenue stream in the last 3 years, you can see a clear growth path. So you might want to argue that you should have 4x or 3.5x the EBIT as a price, the share price for you. And then when you kind of identified which multiple is the best for you, and you decided if you want to argue for EBIT or EBITDA, you go to the normalization process and you try to argue for as much expenses as possible to be added back to hire and as much income as possible not to be taken back, right?
Yeah.
Because you want the highest value possible. So those 3 steps are all part of your negotiation process. You want to decide a metric, and if you use more than one metric, you want to weigh them against each other, what's more relevant for you. When you decide on a core metric, you want to do your homework with the multiples, see how you can argue for the other companies that have been sold in your industry with a higher multiple would be more comparable, more relevant for you in your transaction. And the normalization process, some would do that prior to the multiple, but whichever way you want to do it. You want, again, as much expenses as possible added back and income not be taken out. The higher value for you, right?
Exactly.
Yeah. And then we have a number 4 for you. Once this is done and you end up with a value for your core business, enterprise value for your core business, then you will want to remember also, do we have anything else, any other assets on the balance sheet that's going to go with the industry? Perhaps you own shares in another company. Perhaps you own 3 cars that will go in the transaction, or real estate. Well, then you need to add that to the enterprise value, right, to know how much you're going to get.
So it's a lot of things to think about.
Yeah. And then, of course, we'll have an episode about enterprise value versus equity value, because most buyers will want to buy cash-free, debt-free. But this is how we're getting at the enterprise value. Because what we're looking at here is the value regardless of whether you have debt or not, right? Because this is only for the shareholders. Because here you take care of everything. That's why it's hard to use that as a comparable. That's it.
Thank you so much. It was a lot of information, but you explained it really well.
Thank you.
So now you know really good tools when you are valuing your company, or maybe you're buying a company. You know exactly what they're talking about.
And know how to negotiate, because that's what we can contribute with. This is not legal advice. This is tools, tips, and tricks, because we do want to help you at 0 cost. Because often a savvy buyer comes in, and they might argue that this And this, and the multiple of 3, and the normalization of add back and take back, that's science. That's the way you do it. Always. It's not science.
No. Now you have the tools too.
Negotiate.
It's
Do
key.
it.
It's key.
It's key.
Keep educating yourself, as we say.
And get rich.
And get rich, of
We want
course.
to.
So thank you so much for explaining
Thank
this.
you.
And good luck with buying your companies or selling. And if you have experiences, just drop them down below. We'd love to hear what you are doing.
And if you have any questions, then we're going to dig deep into also working capital and the other aspects that you need to know in the transaction and growing your company and selling it.
Yes. And this episode is powered by LE Fitness.
Thank you.
Thank you so much.
Hej då!
Hej då.